Casino owners and consistently successful traders understand that events with probable outcomes can produce consistent results if you can get the odds in your favor and there is a large enough sample size. Consistently successful traders treat trading like a numbers game, similar to the way in which casinos approach gambling. To illustrate, let's look at the game of blackjack. In blackjack, the casinos have approximately a 4.5% edge over the player, based on the rules they require players to follow. This means that over a large enough sample size, that is, number of hands played, the casino will generate net profits of 4.5 cents on every dollar gambled on the game. This average of 4.5 cents takes into account all the players who walked away big winners, including all winning streaks, all the players who walked away big losers, and everybody in between. At the end of the day, week, month, or year, the casino always ends up with approximately 4.5% of the total amount gambled. That 4.5% may not sound like a lot, but let's put it in perspective. Suppose a total of $100 million is gambled collectively at all of a casino's blackjack tables over the course of a year. The casino will net $4.5 million. What casino owners understand about the nature of probabilities is that each individual hand played is statistically independent of every other hand. This means that each individual hand is a unique event, where the outcome is random relative to the last hand played or the next hand played. If you focus on each hand individually, there will be a random, unpredictable distribution between winning and losing hands. But, on a collective basis, just the opposite is true. If a large enough number of hands is played, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. Even though you don't or couldn't know in advance the sequence of wins to losses, you can be relatively certain that if enough hands are played, whoever has the edge will end up with more wins than losses. The degree of certainty is a function of how good the edge is. It's the ability to believe in the unpredictability of the game at the micro level, and simultaneously believe in the predictability of the game at the macro level that makes the casino effective and successful at what they do. Their belief in the uniqueness of each hand prevents them from engaging in the pointless endeavor of trying to predict the outcome of each individual hand. They have learned and completely accepted the fact that they don't know what's going to happen next. More important, they don't need to know in order to make money consistently. Because they don't have to know what's going to happen next, they don't place any special significance, emotional or otherwise, on each individual hand, spin of the wheel, or roll of the dice. In other words, they're not burdened by unrealistic expectations about what is going to happen, nor are their egos involved in a way that makes them have to be right. As a result, it's easier to stay focused on keeping the odds in their favor and executing flawlessly, which in turn makes them less susceptible to making costly mistakes. They stay relaxed because they are committed and willing to let the probabilities, that is, their edges, play themselves out, all the while knowing that if their edges are good enough and the sample sizes are big enough, they will come out net winners. Consistently successful traders use the same thinking strategy as the casino. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are exactly the same in trading as they are in gambling.